Hey everyone, happy Thursday, May 2nd. It's about 9:50 on the West Coast and it's time for another market update. A really busy week. Going back to last week, we got inflation data, we got appreciation data, it's jobs week, and the Fed had their most recent rate hike announcement meeting yesterday. So let's get right into it. Starting with last Friday, we got the March PCE report, which is inflation, and this is the Fed's favorite form of inflation to take a look at. And as expected, it was really slow progress, kind of like we talked about. There doesn't look like there's a lot of room for things to drop the way things are currently heading. So, looking at the numbers, came in at both the headline and core, both came in at plus 0.3, which was rounded down a little bit what actually came in. For the month, which brought the headline up a little bit, brought the core down a little bit. Housing is still running at 0.43 a month. With you annualize that's over 5% a year, which is too high. So again, it came down a little bit, went up a little bit on the headline. Kind of came in as expected. Sticky as everybody's been talking about. And the one thing to point out here, personal income came in at about 0.5% up for the month. Personal spending went up 0.8%. So we've talked about this before. The more people spend, the higher inflation is. The fact that we're spending more than we were spending increased more than our income increased means that our savings rate went down to 3.2%, which is the lowest since October 2022. So people spending too much, basically not keeping, income not keeping up with their spending, and so their savings dropping and relying on credit and things like that. And eventually that bubble will burst. Next thing we got was February. Again, these are about a month plus behind. The February FHFA and Case-Shiller. These are the major appreciation reports the industry looks at. And, again, home prices continue to stay strong. So let's take a look at that. So Case-Shiller was up 0.4% month over month, went up, to 6.4% year over year from 6% last month. And FHFA came in at up 1.2% month over month, up 7% year over year. Keep in mind, Case-Shiller does not include, Case-Shiller does include cash and jumbo loans, where FHFA does not. So FHFA tends to represent, maybe a little bit lower priced homes. And one thing to point out here, this comment from Diana Olick on CNBC, who's been kind of naysaying the housing market, saying prices are going to drop for a while, to kind of like say why this wasn't a good number for homeowners. Was a strong, basically saying that the reason prices went up was because a lot of people thought the Fed was going to cut rates in February, so that might have driven buyers in. But that doesn't really make sense because, if you were a savvy buyer and you thought rates were going to come down eventually, wouldn't you wait for rates to come down? So that just doesn't pass the logic test. But again, kind of be on the lookout for some of that, mainstream media housing, rhetoric. Next thing we got was Jobs Week. So we know this is really important. The Fed is paying really, really close attention to jobs and inflation. We saw inflation is kind of stalling the progress there. So we need, if inflation is not going to get us where we need to get, then we need basically the labor market to weaken. So this week we got ADP for April, March JOLTS, and BLS tomorrow. So first ADP came in higher than expected. About 175,000 jobs were expected to be created. 192,000 came in. Annual pay increases moderated a little bit, came down a little bit. That could be a sign of a little bit of future weakness. The more we're making, the more we're spending. So, that's that was a positive note in this report, but still, a little bit higher than expected, which, the job market is, or, the markets are not going to like, because again, this, kind of plays into what the Fed's looking at. The next one we got was JOLTS. So this is jobs opening for the month of March, and this actually came down to its lowest total since February 2021, about 8.5 million job openings. Leisure and hospitality compared to ADP were a lot lower. And the quit rate, the amount of people that are quitting to go find another job dropped to its lowest, excluding the pandemic, since 2018. So basically people feel less confident, hey, I'm going to get rid of this job, go find another job. So that could be a sign of the labor market slowing. And again, job openings tend to be the first thing we see a lot of weakness in the job market, because that's the first thing, companies would be cut, job offerings. And then the last thing we got into this week, well, not last thing, but the last important thing, and probably the most important thing, was the Fed meeting. Remember, they have a 2-day meeting. It concluded yesterday. We already knew they weren't going to cut or hike. But the most important part is they release a statement, and then Chairman Powell gives a press conference afterwards. And really, what Powell had to say in the statement, the market reacted pretty positively to. So let's get a little bit more into this. Big important thing, the balance sheet. We've kind of talked about this a little bit. Basically the Fed has a certain amount of treasuries and mortgage bonds actually too that they keep on their balance sheet, and they've been running them off, selling them off, and they're going to reduce that from slow reduction from 60 billion to 25 billion. So that will free up 35 billion for them to reinvest. So that's going to be good for treasuries. That's going to start in June. That's something the market really reacted positively to. He also said that people asked, will there be a hike? What if inflation? Will you hike again? He was pretty adamant, saying that they wouldn't hike. Which sad that we had to get to this point. When we want them to cut, but good that he said that. And then this is a really important part. People asked, if inflation stays where it's at, and unemployment rises, would that trigger a cut? And that's what we've kind of talked about. And he said a couple of tenths would probably not do it. Remember, it's at 3.8 right now, but a surprise would. So, what MBS Highway has to say right here, 17 out of 19 members are forecasting unemployment rate to stay underneath 4.1% or below. Right now it's at 3.8. So a surprise, if it went to 4.2% or above, that would be probably something that would freak the Fed out. That would be a surprise, and that could lead to a rate cut, which is what we want in the long term. And then he also shut down, about stagnant inflation, basically saying the economy is looking really good, all that kind of stuff. So that's something he shot down pretty quick. Initial jobless claims came in today at 208,000 new jobless claims. 212,000 were expected. Again, the same exact number as last week after like 6 straight weeks of 212, which is really weird. But these stay at really low numbers. So looks like it's, employers are still trying to hold on to employees. Where did that leave us? The average 30-year conventional jumped above 7.5 last week to 7.52. We're about 7.42 because of this positive Fed, reaction yesterday. And this hasn't updated since this morning, and the market's rallying a little bit right now. So maybe let's say a little about 7.4, so 7.35. For, again, this is according to a lender survey. That doesn't mean you'll get this if you go to us or somebody else, but that's just, the average for good borrowers across the country according to lenders. So important dates tomorrow, really important coming up is the BLS jobs report. This one kills us every month. It has been. This is where the unemployment rate comes from. So what we just talked about with that unemployment rate, they expect it to stay where it's at. They expect a pretty big job creation number. So if that misses, if that comes in under that 243,000 jobs created that they expect, if unemployment ticks up, that's something that could go in our favor. But really long term, that's what we're going to need. We're going to need unemployment to tick up in order to get the Fed to cut rates, it looks like, because it doesn't look like we're going to get much movement on that inflation down to that 2% core rate, which they're trying to target. So if anybody needs anything at all, please don't hesitate to reach out. Rates are still high, but keep in mind when rates do come down, that just creates more competition. Sellers are not going to be willing to work with you. As far as, seller concessions, you're going to be facing more offers. You're probably going to have to be paying over asking. Things like that. So, if it makes sense now for someone to buy, that's when they should buy. So just keep that in mind. If anybody needs anything at all, please don't hesitate to reach out. Otherwise, have a great week, everybody.